Welcome to the micro lecture, Sources of Funding. In this lecture, you will learn about the different sources of funding and the different investor types. You will learn the terms dilutive and non-dilutive, and you will get some input on debt and convertibles. So let's start simple. Why do you need investment in the first place? Can't you simply scrap up your savings and grow your venture organically by simply selling your product or services? Well, that depends on your line of business, but more often than not, the answer is no, especially in areas with a high need for research and development activities. And by the way, the approach to make it without any external money is called bootstrapping. But if you need capital, you will have to look for funding sources, and here's an overview, and I'm going to explain it to you in detail. Usually when you talk about investors, you are thinking of dilutive investment, and that means that someone is giving you money and expects a share of your company in return. And this might at first be your family and friends, and you might also be able to find a business angel. And that is an individual, usually from your area of business, that likes your idea and is willing to pour some money into your venture. And then there are also high net worth individuals or families who want to invest their wealth via family offices. And of course, you have venture capital. And venture capital comes in many different flavors. So there are governmental sources, governmental VCs, and their job is to foster young startups, and they're usually agnostic to the field you work in. And you have corporate VCs, venture capitalists, who primarily invest out of strategic reasons. That means they want a foot in the door. That means they want to be on board when it comes to new developments in their field. And they care very much about the area you operate in. And last but not least, you have the classic VCs, which usually have a thematic focus. They're basically looking for good returns on their investments. That's not all. There are also other sources. For more mature companies, there's, for example, the stock market. And you can create some money by initiating an IPO, an initial public offering. And sometimes you might also be able to acquire some capital via crowdfunding. But that's not all. There's also another way to acquire capital without having to give up a share of your company. So it's non-dilutive. And here under the category of sponsorship, we list foundations, research programs, startup programs, incubators and accelerators. Of course, the boundaries between them are sometimes blurry, and some of the above mentioned might also operate an equity-based system. And please keep in mind, the money is not for free. It's usually tied to well-defined activities and developments. And then there's debt. And debt is a difficult issue for budding companies. So nothing stops you personally to max out your credit line and invest into the company, but a company cannot operate in that way. First, there are usually no collaterals to borrow a huge amount of money in the first place. And that might also force your young venture into insolvency if you cannot balance this with other sources of equity capital. However, there is a debt-related instrument you should definitely have heard about, and that is convertibles or convertible loans. And a convertible loan has the character of both debt and equity. So it basically represents an approach where money is given to a company in the form of debt, and later, the next investment round is turned into an equity share. This is usually done to avoid having to evaluate a company early on. But there are also a number of other reasons for it. Please be aware, there are often many provisions attached to it, and these might play out negatively in the eyes of the founders. So it's paramount to get a good understanding of the conditions. So today we've learned about sources of funding, different investor types. We now know what the terms dilutive and non-dilutive mean, and you've got a better idea now about debt and convertibles.